Hello and welcome to the FT studio in New York. My name's Gillian Tett and I'm joined by John Authers, who is our investment and markets guru at the Financial Times. And we're here to talk about the extraordinary developments in the markets where the Dow Jones plunged by 1,000 points this morning on its opening. So, John, what do we make of this? Is this just a summer squall of investors panicking, or is there something more serious going on in the world markets today?
I think you can actually say that it's both. Plainly, there's for a long time been this big retreat from the trade centered around China that also involves other emerging markets, their currencies and commodity producers. Steadily, people had been losing confidence in the China trade for some years, and with the most recent announcements about China's devaluation, their failure to prop up the Chinese stock market, there is now a sense that the Chinese authorities aren't in control. That means that key assumption that the Chinese authorities know what they're doing, that they control the levers, is at last being called into question. So there's certainly a big long-term tectonic shift going on. In terms of the US, that 1,000-point dramatic fall in the Dow, it still is more consistent just here in the US with an extreme summer squall of the kind we've had several times.
So let's unpack that a bit. First of all, why does anyone in the US care that much about China? Because yes, China's a big economy, but it's not that big.
Well, and it's not that exposed to the US. I mean, in many ways, the US doesn't export that much to it, and it could do without the competition from China in a lot of areas. It's quite right. When you look at the effect it has on interest rates, on growth in the world as a whole, that is significant. In particular, it feeds into arguments about the strength of the dollar, which has been strengthening greatly as people have got more nervous about China. And that in turn feeds into whether the Fed really is going to tighten. At the point the US is in its cycle, plainly we would be ready to start raising rates. Given the kind of turmoil we're seeing in the markets, that's the last time the Fed should be raising rates.
Now, Janet Yellen and other senior members of the Fed have indicated in recent months they're very, very keen to get on with raising rates. They want to normalize policy after this extraordinary period of zero interest rates. Do you think that they will actually have the courage now, next month, to pull the trigger?
If I had to bet at even money at this point, I would bet that they don't do it next month. I think you could find there's a very close parallel for this with the taper tantrum 2 years ago, when emerging markets sold off at the notion that the Fed was going to start tapering off QE at that point as early as September. And as a result, the Fed decided, I think largely because of the market response, that it was going to wait. It shocked people by not tapering in September and then did so in December. If I absolutely had to bet on one single path, that's roughly what I would now expect in the Fed. I think the scare that this has created, particularly in emerging markets, means that we're probably putting back the timetable for rate rises yet again.
Well, we have a terrific piece by Larry Summers in this morning's Financial Times, which should be required reading for everybody, basically making the point that he thinks that even before the market crash, rates should not go up for a very, very long time. In fact, there may even be, a case for, ideally for even weakening rates. But do you think that he's correct to argue that? Because, of course, one of the issues is that unemployment is hovering around the level that the Fed indicated it would start to raise rates at, 5.2, 5.3%. We're having 200,000 average job creation each month. So if you look at the labour markets, the Fed actually should be raising rates right now.
Well, quite. There are arguments about whether the unemployment figures are unduly positive, which we won't go into, but nobody can argue that the labour market requires emergency level low rates. The thing is, the Fed has a dual mandate. It also has to worry about inflation, one of the very few central banks around the world that does. When it comes to inflation break-evens, I think this is overdone, but we are back in a really serious deflation scare. At the moment, if you derive imputed forecast for inflation over the next 10 years from the bond market, we're predicting less than 1.5% a year for the next decade. So that's not just about the effect of lower oil prices, which will be out of the calculation well before the decade is out. This is serious deflation scare once more. It's lower. Ben Bernanke used to watch this very carefully, and it's lower than levels at which low inflation expectations prompted him to resort to QE twice over the last 6 years. So That is the big argument against it. Yes, on unemployment, there's really no reason to leave rates where they are. On inflation, there is no reason to raise them.
So the other area where, of course, there is a lot of falling prices right now is in oil and other commodities. Yeah. Extraordinary prices this morning with oil falling towards $42 a barrel. Yeah. You've got even diamonds, apparently. The business planning to cut diamond prices by 9%.
I didn't look that one up. Wow. Right.
Exactly. Anyone who wants diamonds, rush out and grab them now.
Right.
But I mean, are you expecting to see this commodity price weakness continue, or is this just part of the general concern about economic slowdown?
I think it probably stays weak for quite a while because it takes a while to adjust supply. Iran seems to be serious that it's going to really start pumping out oil as soon as it is allowed. Saudi Arabia, for many economic and obviously big sort of cultural, geopolitical reasons, has no intention of reducing supply. Here in the US, which was a big part of the glut of supply in the first place, we've discovered that people hadn't adjusted their supply downwards either. That all leads to the suspicion that we're not going to see the end of low oil prices for a while. Plainly, if China pans out to the worst end of expectations, then you get that big demand. Lower demand plus higher supply means lower prices. Now, I think, yes, that oil, if anything, could go somewhat lower from here. In the long run, that's positive. In the short run, particularly as that's been a big stimulus for investment in shale and all the rest of it here in the US, in the short run, that's a problem.
So bottom line, we've got faith cracking in the ability of the Chinese government to actually manage their economy. We've got concern about overall global growth. There's a lot of emerging markets. Currencies and countries are suffering from this whole turbulence. Yes. We've got people rowing back their expectations of the Fed at doing anything, ultra low inflation trends in the US, and we've got commodities falling. So when you add all that together, do you think that today's extraordinary market turmoil is just going to be a short-run summer storm, or do you think it's actually pointing to a much gloomier period, dare I say, even a change in the weather in terms of the stock market climate?
If I absolutely had to bet, I suspect that you might see quite a rebound before too much longer here in the States, largely because of the Fed effect. You don't fight the Fed. People had been expecting the Fed to raise rates, but this is still not necessarily justifying it. There's many worrying things about the dependence on low rates, but it's a fact. If you want it, so my best guess is that we are in the middle of a summer squall that will correct itself to some extent back upwards in the States. I doubt that the great downward grind in emerging markets and all the things that are linked to them, that are all ultimately linked to China, is over. How bad it's going to be depends on exactly how bad the situation in China is going to be.
Right. Well, that's great, John. It's almost encouraging. It's clearly a great time to be going out and filling up your tank and your car with gas or petrol, depending on when you live. Maybe a good time to buy diamonds too, and possibly even a time that we shouldn't be panicking about the stock market. Who knows? We'll see tomorrow. Thank you.